I'd like to welcome everyone to this third webinar in our Winter-Spring series sponsored by the NACAPA team. NACAPA is the New England Canadian Provinces Alliance. My name is Halsey Snow. I'm a semi-retired business owner, educator, and environmental activist. And NACAPA is a grassroots network team composed of volunteer activists, both in New England and the Canadian provinces. Our speaker today is Gabriel Gregory. Gabriel Gregory holds a Bachelor of Commerce from Memorial University and is a certified management accountant through the Society of Management Accountants. Mr. Gregory has spent most of his decades-spanning career in the fishing industry and brings extensive knowledge and experience to his role. He is currently the principal of a private consulting company that provides fisheries and management consultant services to both industry and government clients. Throughout his career, Mr. Gregory has held senior executive roles at Beothic Fish Processors Limited as president and at Fishery Products International Limited as the executive vice president of Atlantic Operations. In addition, Mr. Gregory has served as the chairman of the Canadian Centre of Fisheries Innovation, vice chair of the Fisheries Resource Conservation Council, director and president of the Canadian Association of Prawn Producers, and director and president of the Groundfish Enterprise Allocation Council. Thank you so much for being with us today, Gabe, and I turn it over to you now.
Well, thanks for that introduction, Halsey. My interest in this particular subject is as a Newfoundland-Labrador citizen. I grew up during the time of the initial development on the Upper Churchill, and I followed this project closely over my lifetime and took particular interest when the governments of Newfoundland and Quebec made their announcement in December to really dig in, research, and analyze most aspects of the MOU that are known publicly. So that's why I'm here. Thanks for the invitation. And I'm going to be about an hour. And I'd like to start with just a brief overview of the Churchill Falls hydro development that took place back initially in the 1960s when it commenced. And for those who aren't familiar, the geography of Labrador is quite unique. Most of the interior plateau of the Labrador region drains through the Churchill River, one very large water system. The drainage area for the Churchill River, as it's known today, referred to as the Grand River by many, is a drainage area about the size of the province of New Brunswick in Canada, 72,000 square kilometers. The reservoir that feeds the power plant is 5,700 square kilometers in size. It's very, very large, one of the largest in the world. And the capacity of that reservoir is 1 trillion cubic feet of water. It's a unique development in the Upper Churchill in that there are no dams. There are many, many earthen dikes that were built around the reservoir. There's 88 dikes in all, over 64 kilometers in length. The highest of these earthen dikes is 117 feet in height, and the longest is over 6 kilometers. This is a depiction of the power plant at Churchill Falls. When it was built, it was the largest power plant in the world. It was the largest construction project undertaken in the entire of North America. And what's unique about the Upper Churchill plant is that it has a very high hydraulic head. The drop between the reservoir and the turbines is over 1,000 feet, or over approximately 300 meters. And the reservoir feeds 11 penstocks, with turbine generators with a total capacity of 5,428 megawatts. When this construction was undertaken in the late 60s, it was forecast and budgeted for $1 billion and construction period of 60 months. It was actually came in under budget. So for a huge mega project, it was extremely well managed and executed, and it was finished ahead of schedule by 6 months. So quite a unique undertaking. The contract that was put in place between private interests at the time, the builders of the Upper Churchill, Brinko, and Hydro-Quebec, they formalized the contract in 1969. That contract remains in place today. The contract is with the Development Corporation, CFLCO, Churchill Falls Labrador Corporation. That corporation is owned today 66% by the government of Newfoundland-Labrador and 34.2% with Hydro-Quebec, a public utility in the province of Quebec. The initial contract was for a 40-year fixed term, and prices at the time started at 0.3 of a cent a kilowatt hour. That was for the first 5 years of the contract. And then it progressively reduced as the contract proceeded. After 40 years, the contract required a 25-year automatic renewal, and at renewal, the price remains fixed to the end of the contract, 65 years, at 0.2 cents per kilowatt hour. We're talking about 1/5 of a penny, and we don't make pennies anymore, so this is extremely cheap power by any standard. It's for established volumes of power, and there are no open or exit clauses in the contract. The expiry is actually at August 31st, 2041. So many people in my generation are hoping and wishing for the day that they can live to see the expiry of this contract, because it's so prejudicial to the interests of our province and so beneficial to the interests of Quebec. Before I get into the actual summary and presentation of the Memorandum of Understanding, I'll just give some backdrop on the electricity market in North America today, particularly in the United States and in Canada. AI is to revolutionize most everything about our way of life and work, and there are enormous sums of investment by the large tech companies to be the leaders in artificial intelligence. This is placing an extraordinary demand on electricity, particularly in the US. The data centers alone, their demand for power has grown 50% in the past 5 years, and that demand is expected to more than double in the next 5 years to 2030. The overall power demand is expected to grow by 13 to 15% a year until 2030. And as JP Morgan quotes, is potentially going to turn electricity into a much scarcer resource. In our own country, Canada, we look at the Canadian Climate Institute, their most recent report states that electrical generation, if Canada is to meet our needs and transition away from the use of fossil fuels, we're going to need to grow 3 to 6 times faster in the next 25 years than we have in the previous decade to meet our climate goals. So there's going to be a huge shift in transition toward electrification. This is the backdrop to the MOU. The MOU was signed officially by the province of Quebec through Hydro-Quebec and the province of Newfoundland through Newfoundland-Labrador Hydro, both public utilities, on December the 12th, 2024. And for the rest of my presentation, I'm really going to focus on a high-level summary of what's involved with this MOU. There are really 5 substantial components to the MOU: the replacement of the existing Churchill Falls contract, the upgrade of capacity at the existing Churchill Falls power plant, the construction of a new underground generation plant next to the existing Churchill Falls plant, the development of the Gull Island hydroelectric site, and the construction of significant new transmission through the province of through the Labrador region. Each one of these components really should be considered separately, in and of their own. They have they're very large projects, very expensive projects. They're long-term projects. The power involved varies, but a substantial power involved. The price is variable to each of them. The cost, benefits, and risks are unique really to each of them. And there are many other considerations, particularly on the environmental side, associated with many of these developments. So I'm going to take them one by one. The first is the replacement of the existing Churchill Falls contracts. Currently, there's the old 69 contract, and there was an amendment to that contract in the late 1990s when Quebec was seeking a guarantee of power through the winter months or from really December through to the spring. And Churchill Falls Corporation was in financial trouble at the time. Its expenses were expected to exceed, through inflationary increases, the fixed price of power that was being paid. And there was a modification whereby there was an annual payment added by Hydro-Quebec to CFLCO, roughly in the amount of $35 million. So today, the annual revenue from Hydro-Quebec through these existing contracts totals approximately $95 million per year. The replacement of the contracts under the MOU is again for a fixed period of 51 years. The term here is from 2025 inclusive to 2075. There's a high risk because there's no adjustment for any unforeseen events, and there's no exit clauses in this MOU as is contemplated, similar to the 1969 agreement. The renewal sets forth the annual volume of power from the existing plant for each year from 2025 to 2075. So there's a subscribed set amount of power to go to Hydro-Quebec and to be available to Newfoundland-Labrador Hydro. Currently, the volume of power is split roughly about 4,765 megawatts to Hydro-Quebec and 525 megawatts to Newfoundland-Labrador Hydro. And here I've summarized really at various points through the 51 years how the power allocation between the parties is to play out. Quebec's allocation is set to decline some over the 51 years, and Newfoundland-Labrador Hydro's is set to go up at intervals over the 51 years. But the power and energy subscribed to each is set and agreed. The power is owned by CFLCO, which, as I said, is a corporation owned approximately 2/3 by Newfoundland-Labrador Hydro, 1/3 by Hydro-Quebec. And the MOU sets forth the payments that are going to be made for the power from Hydro-Quebec to CFLCO for each of the 51 years of the contract. Starting in 2025, the nominal price being the price in the year of value, 1.6 cents a kilowatt, increasing through inflationary changes over 51 years to 37.2 cents at the end of the contract. And here's a depiction by way of a chart showing the annual price in nominal dollars over the 51-year period, as set out in the MOU. The total value of this power, however, is qualified and set in the MOU to be $33.8 billion in present day terms. So when we're talking about the difference in value, I like to focus on what the real today value is in real dollars, 2024 terms, because who knows what the value of electricity is going to be next year, 10 years, 50 years down the road. That's one of the principal problems with the existing contract, of course, is that it was for a fixed price. Here we have a contract that's not set by a fixed price annually, it's set by a fixed established value over the 51 years. And that value is $33.8 billion in today's value. And the average price over the term in real terms of the contract is 2.5 cents a kilowatt hour. So the MOU is for an agreed, established, fixed value in 2024 terms, $33.8 billion. Now, when we look at this existing Churchill Falls plant, it's been operating since 1971, 54 years. It's a proven, highly reliable system, has little or no operational risk. It has no debt, no financial risk, and the cost to produce power at Churchill Falls is approximately 1/5 of a cent a kilowatt, basically what it's being sold for. So when you compare the cost of power at 0.2 cents a kilowatt relative to its value today, it basically producing power for virtually no cost. And when I come to the revenue side, you'll see that this is a very, very highly profitable asset. It's a virtual cash machine, I call it, because all of its revenue is basically by way of profit because the cost to produce power is at a very, very low level. In the most recent year that I reviewed was 2023. Hydro-Quebec sold out of its network almost as much power as it was supplied by Churchill Falls. And it sold that power for 10.3 cents a kilowatt on the export market in 2023. And it paid 0.2 of a cent a kilowatt for the power. So its selling price was 51 times the cost of power. The value that was achieved by Hydro-Quebec in 2023 was actually over $3 billion for that year. Now, since that time, I think in recent report, you would update this. In the most recent sales, the prices have reached substantially above even what they sold power for in 2023, up to 15 cents at times. And Newfoundland-Labrador Hydro, because of its ownership in CFLCO, is paying the same low fixed price for power from Upper Churchill. And it shares in the profits from CFLCO due to its ownership. But because the revenues are so marginally close to the costs, there's limited and restrained profit in CFLCO. Newfoundland basically gets about $20 million a year benefit from this, relative to Hydro-Quebec's benefit in excess of $3 billion. So it's from an economic point of view, is a very distorted financial circumstance that's fixed and is going to remain fixed even under the MOU, and I'll come to that. So when we seen the announcements from the governments of Newfoundland and Quebec in December, talking about hundreds of billions of dollars in financial benefits from the MOU, these benefits are really being derived from the existing Churchill Falls power plant. By far, the majority of the benefit in financial terms they're describing is from the existing plant. Hydro-Quebec reports that it has secured 7,200 megawatts of power from this MOU for 51 years at an average cost of 6 cents a kilowatt. And this is their combined cost, which includes the high cost of new power from the expansion projects contemplated under the MOU. and I'll look at through these individually. When you take into account the enormous profit and benefit that Hydro-Quebec is going to derive from the MOU, they're going to use those profits to subsidize their combined rate for power down to 4 cents a kilowatt over the 51 years. And as Michael Sabia, the CEO at the time, referred to this when questioned publicly about, why this deal, what is its benefit to Quebec? He was very quick to point out that this is a remarkable price for renewable energy, a price that, in his terms, quote unquote, does not exist. It does not exist in the marketplace in North America. It's very remarkable the price they've achieved. So when you look at this in real terms, Hydro-Quebec's net average cost for this power for the next 51 years is going to be 1.6 cents a kilowatt, a very low cost. We look at the benefits in the short term of the MOU from Newfoundland Hydro, Newfoundland's point of view. It's estimated and forecast in nominal terms, they'll get about $12 billion or 700 million a year in nominal terms. What we have to understand is that in the province as citizens of Newfoundland-Labrador is that under the MOU, the way the pricing is schemed and put together, all of the payments between now and August 2041, the expiry of the old contract, they're really being advanced in that time, the 16 or 17-year period, and they're being repaid over the period from 2041 to 2065 through lower power rates to Hydro-Quebec. So Hydro-Quebec's going to advance or pay more for power until the old contract time expires, and then they're going to get lower rates in the period from 2041 to 2065 to repay for the advances that were made in the early part of the MOU. And in fact, when you realize this when you analyze this, from a financial point of view, CFLCO, if it had stayed with the existing contract to 2041, it would realize in today's dollars $10 billion more, or $67 billion in inflated terms more, if it had stayed with the existing contract to 2041 and then sold power at Quebec's, what their stated lowest alternative replacement cost is, as stated today, which is 16 cents a kilowatt. So this is just an example of how beneficial the MOU is and how imbalanced the MOU is in regard to, from a financial economic point of view, in Quebec's favor. In real dollars, the average net annual value to Hydro-Quebec over the 51 years is $423 billion in 2024 dollar terms. So the existing Churchill Falls power is being sold at a very steep discount to its replacement cost and to its market value over the 51-year term of the MOU. There is no provision for market rates in the MOU, and there's no provision for any escalation due to real changes in the market that may be driven by, the demand, as I said, for electricity. If you look at it from a data center point of view, or either any economic development unforeseen that could arise over the next 5 decades, likely to be the case, but unknown, but certainly been the case over the life of the prior fixed contract that we've been living with. No reason to expect different, I don't think, but that is the nature of the MOU. Newfoundland and Newfoundland-Labrador Hydro is not getting any access to wheel power through to the export market itself. It has no right to export market through Quebec, as has been discussed for a long time. And the government of Newfoundland really gets no access directly to any funding under the MOU, all of the funds and revenues flow through CFLCO. So in summary, when you compare the 69 contract to the 2024 MOU, the term is similar, it's fixed. Different term, 40 plus 25 under the old contract, the new 51-year fixed term. The volumes of power are fixed, as I summarized. The value is fixed. Here it's fixed in 2024 terms. Under the old contract, it was a fixed price per kilowatt. The price under the old contract was 0.3 of a cent to 0.2 of a cent. Under the new MOU, it averages 2.5 cents in today's terms. There was a cost for the construction in 69. In 2024, of course, there is no cost. This is an existing plant, fully operational, fully paid for. There are no adjustment mechanisms in the old contract, and there are no adjustment mechanisms in the new MOU. And as I described, the benefit to Hydro-Quebec used to be in the millions and billions per year. Now it's going to be in the billions per year. And for Newfoundland, we got a small benefit in the past, 20 million a year approximately recently. That's going to increase to about 425 million a year under the MOU. So when we look at this, really the MOU, as I summarize it, in principle, it's the same contract as 1969. There's no market rate per power. There's no contract openers. Really nothing fundamentally has changed in the contract. Now I'm going to come to the second major component of the MOU, which is the upgrade of the existing Churchill Falls power plant. And here is an undertaking whereby they're going to basically replace and upgrade the existing 11 turbine generating units in the existing plant. Because of efficiency of new units, they will be able to increase the capacity by 550 megawatts, approximately 10%. So now this plant will have a capacity of just under 6,000 megawatts. It'll still be the second largest electrical generation plant in Canada, second only to the Bourassa plant in Quebec, which is marginally higher than that. And this construction will be led by the existing company CFLCO. The cost will be estimated to be 1.9 billion, and they're basically going to replace one turbine unit per year for over 11 years, contemplated between 2028 and 2038. The term for the upgrade is 51 years. And again, this will be under contract in the MOU with no renewal, no exit. Most of the power from the new upgrades, certainly all the power from the first 6 years of the upgrades, is destined to go to Hydro-Quebec. That's prescribed under the MOU. This is going to be a project financed 100% by debt within the company. And Hydro-Quebec is going to be getting the majority of that power on a cost basis, which is estimated to be 6.5 cents a kilowatt hour. Over the life of that contract, CFLCO will be selling that incremental power at a discount to the 2024 price of approximately 7.2 billion less than the replacement cost of 16 cents, and it's at a discount of 3.2 billion less than the agreed prices for the existing Churchill Falls power under the MOU. So we're going to be generating new power from a new efficient investment, and we're going to be selling that power at less price than the existing energy from the existing plant, significantly less. In regard to risk, of course, there's always on any major mega project significant potential for cost overruns. Here, those cost overruns are to be shared based on the shareholdings within CFLCO. basically two-thirds, one-third. There's always large construction and management execution risk associated with labor, material, interest rates, inflation, and other environmental and operational factors. The next one I'm going to come to here is the new Churchill Falls power plant. So what's contemplated here is the construction of an expansion of the power plant at Churchill Falls to build an adjacent underground plant with two large generators, 1,100 megawatts of new capacity, again, owned and operated by CFLCO. But this construction is going to be managed entirely by Hydro-Quebec and financed by Hydro-Quebec initially. The cost is estimated at $4.6 billion. The term is over 50 years upon completion. And similar to the other aspects of the MOU, there's really no renewal or exit clauses in any of these contracts. Virtually all of this power from the new plant is destined for the Hydro-Quebec system. Any additional power under the MOU coming to Newfoundland and Labrador is really contemplated and tied to completion of Gull Island, with some additional allocation, as I spoke about, from the existing plant. So this second plant at Churchill Falls, or adjacent plant, is going to be owned by CFLCO, the existing company, and is going to require a new equity investment from Newfoundland-Labrador Hydro of about $757 million. This new plant has many substantial risks. I haven't attempted to quantify them or elaborate on them much, but basically, there's no new energy for this plant. The existing reservoir is fully being utilized and producing all the energy that's available from Upper Churchill, approximately 34 terawatts of power annually. This is new capacity, new generation capacity. So, once this development takes place, this will be the largest electrical generation site in the entire country. It'll be in excess of 7,000 megawatts of power at Churchill Falls. And this capacity is planned to be used to supplement additional new generation from renewable resources like wind in Quebec. So to the extent that this plant operates, it'll be running as more or less a peaking operation for additional power to replace other renewable energy that's planned in the province of Quebec. And of course, as we all know, wind generation is efficient, it's relatively cheap, but it doesn't have continuous reliability and dispatchability. Unlike hydro, and particularly at Churchill Falls, where you have a very large reservoir or bank of energy in the reservoir, you're able to dispatch power basically on demand. So this is going to have a very significant change in the environment of the river when we have a large capacity plant at Upper Churchill generating power on demand day to day to supplement energy that's not available from wind, for example. Then you're going to have periods of very high water flows changing to periods of very low water flows. Basically, it could be even day to day. So this is going to have a big, big significant impact on the river system downstream. It's going to totally change the dynamics of the river. It's going to change the entire downstream power generation. So water management on the entire system is going to be a very significant challenge once this capacity comes in place. There are risks, of course, to this new development, costs and potential cost overruns. There may be substantial impacts on the existing plant when this is under construction just meters away from the existing plant. All of this construction management and execution is going to be undertaken by Hydro-Quebec with basically only a periphery consultation with Newfoundland-Labrador Hydro. And of course, then there are all the other ancillary risks that go along with any significant mega project. There's been no consultation or assessment of any kind on what was referred to as CF2. And with the developments, nationally taking place recently, there's really a big question mark as to the extent that there will be any meaningful consultation or environmental assessments undertaken on many of the developments under the MOU. So Hydro-Quebec is going to be getting 1,100 megawatts of additional capacity at relatively low investment because most of the financing and investment is being undertaken and at the risk of Newfoundland-Labrador Hydro because of its 2/3 ownership in the company. What we have to realize, of course, is that this is all about new capacity. There's no new energy. There won't be 1 kilowatt hour additional power produced. So really, there's no benefit from an energy point of view to Newfoundland and Labrador for the capital investment. And all of the decision-making is entirely in Hydro-Quebec's hands. And this is being tied directly to, as announced by Quebec and being currently undertaken, a substantial wind generation up to 10,000 megawatts in the province of Quebec. The fourth component of the MOU that I'm going to speak about is the development of Gull Island. This is by far the largest investment component of the MOU. And this is just a Google depiction of the lower Churchill River. You can see the road system here. The Trans-Labrador Highway is the highway crossing horizontally on the picture. And the highway coming up from southern Labrador, crossing the Labrador River just west of Goose Bay. And of course, just upriver there on that depiction, you can see where Muskrat Falls is located at the narrowest point, just west of where the bridge crosses. And then at the extreme southwestern part of the depiction is where Gull Island is located, where the new dam will basically dam off the river. So this is the construction of a very large dam. This dam will be like 1.25 kilometers across and some 100 meters high, approximately 300 feet drop at Gull Island, contemplated. It will be the construction of a new generating plant there, contemplated to be 2,250 megawatts with 5 turbine generators. This is going to be undertaken by a new joint venture company owned by Quebec and Newfoundland. Basically 60-40 Newfoundland-Labrador Hydro relative to Hydro-Quebec. And it's expected to be commissioned 2035 with a cost of just under $25 billion. The term of the contract contemplated to govern the Gull Island development is 50 years, no renewal, no exit, a fixed price contract similar to what was put in place in 1969 at Upper Churchill. And you can see here a depiction of the dam, the powerhouse, the spillway that's contemplated at Gull Island. From this development, Hydro-Quebec is going to get over 2,000 megawatts of new energy, and Newfoundland is going to get some 225 megawatts of new energy. As I spoke about, the cost is $25 billion. It's going to be financed 75% debt and 25% equity. So Newfoundland's share of that equity is going to be $3.7 billion. and the rest is going to be financed by debt between Hydro-Quebec and Newfoundland-Labrador Hydro. This is a huge mega project in size, subject to substantial risks. However, the construction management and execution is going to be undertaken by Hydro-Quebec. And if you look at Hydro-Quebec relative to Newfoundland-Labrador Hydro, it has a very good track record of construction management, execution, and financial management of the developments in hydro it's undertaken over decades, whereas Newfoundland-Labrador Hydro has very poor experience. Most recently, we've seen that, of course, at Muskrat Falls development. I'm not going to go into that, but in every aspect, there was very, very poor construction management, very poor execution, and really terrible financial outcomes. And of course, these mega projects have enormous risks in regard to labor, supply, skills, material issues, and of course, they are subject to a lot of financial risks, as we've seen. There's been no public consultation on the Gull Island development, and there is none contemplated that we know of. The proponents are banking on the 2010, 2011 environmental assessment that was done by a panel back then. They made no recommendation for approval back then, but the government's approved the assessment at that time. It's contemplated that there won't be a new assessment required for Gull Island, even though, of course, that's 15 years taking place. And as I spoke about, the development at Upper Churchill are going to have also a huge impact on the water flow and the environmental impacts related to that water flow in the Churchill River Valley. So once the river is dammed at Gull Island, it will basically flood the entire river valley back to Churchill Falls. It'll have a huge environmental impact in that regard. There will be no significant reservoir. The plant will run basically as what's referred to as a run-of-the-river operation, which is very unlike the Churchill Falls development. So there'll be a lot of issues associated with water management on the system once these dams are put in place. And there will be a lot of downstream impact as well on Muskrat Falls. But these developments at Churchill Falls and at Gull Island are really going to be integrated into the Hydro-Quebec network and run as Hydro-Quebec dictates, as currently the Upper Churchill plant has done for the last 55 years. So Hydro-Quebec is going to be getting 90% of the power. And when you look at the relative investment risk, that's low compared to Newfoundland is only getting 10% of the power, but it's taking 60% of the investment risk. So the investment risk is mainly to Newfoundland-Labrador Hydro. There's a low benefit relative to the large capital investment for Newfoundland-Labrador Hydro. There is provision under the old environmental assessment that Newfoundlanders and Labradorians would get preference for work, but this will be managed by Hydro-Quebec. So, one could expect that there'll be issues in that regard. They'll be running the project. They'll have all authority to make all of the decisions. They will own all of the development rights and IP rights associated with the development at Gull Island. And they will get cost-based power, which is estimated at 11 cents a kilowatt, not market-based power. None of the power under the MOU is being priced at market value. It's all being priced at fixed term cost-based pricing, with the exception that at Churchill Falls, for the existing power, as I spoke about initially, that power is at an established value price of 33.8 billion for the 51 years of power going to Hydro-Quebec in 2024 dollars. The last component of the MOU is the new transmission that's going to take place and be required in Labrador. Under the MOU, it speaks to 340 new kilometers of 735 kV AC transmission lines. And this is similar and consistent with all of the major developments in Quebec and in the Quebec network. They run off 735 kV AC transmission. These transmission developments in the province of Newfoundland and Labrador are going to be built and owned by Newfoundland Hydro, and they will have to be commissioned and guaranteed for completion prior to any new capacity coming on stream from any of the developments. The estimated cost is 3.6 billion. There's no term stated on the transmission development. There are no conditions stated in the MOU. There's basically only a statement that Newfoundland-Labrador Hydro, through Newfoundland-Labrador government, will have to guarantee the completion prior to new capacity coming on stream. The cost is stated to be 3.6 billion, but as we know, Newfoundland-Labrador Hydro has had not a very poor outcome in regard to the development of new transmission, particularly at Muskrat Falls. That was a huge part of the economic problem that arose from that development, where the cost just ballooned. It wasn't only associated with the development at site in Muskrat Falls. Very large component of the overrun was associated with transmission and difficulties with transmission operation. We know and are living with still today that the transmission is not running as planned to this date. The financing for that, you have to assume that there will be some. There's none stated in the MOU. I've just used an assumption of 25%, which would require $900 million worth of equity from the province of Newfoundland and Labrador to finance the new transmission in Labrador for these developments. So there's going to be a significant requirement for additional equity that's not spoken to in the MOU. The overruns are all on the province of Newfoundland and Labrador. There will be a schedule that will have to be met because of the guarantees, and there will be many risks associated with the development of transmission, as there was with the Muskrat Falls development. Here we're talking about, building transmission where there are no roads, no access in the wilderness of Labrador. There have been no environmental impact statements or assessments of any kind or studies done in regard to new transmission through Labrador. And it's questionable, given the timeframes that are being spoken here within the MOU. For example, if they proceed with CF2 or they proceed with Gull Island, which are totally at the discretion, by the way, of Quebec, there's no guarantee in the MOU that Hydro-Quebec will develop any of these sites under the MOU. They've been given the exclusive rights for a period of a couple of decades under the MOU, but they could always decide not to proceed. There's no definitive agreement to proceed. But if we assume that they proceed with any development, then they are going to require transmission, and they don't have any studies or environmental impacts done, assessments done on transmission. It'll be questionable whether they're planning to do any, given their haste to move on. So in summary, from a financial point of view, we're talking about 5 projects in total comprising $35 billion worth of investment. 25 of that is at Gull Island. Newfoundland's share of the equity required for these investments is $5.4 billion. There's only 4.8 of it spoken for in the MOU, and none spoken for in regard to the transmission. And Newfoundland's share of the debt associated with this investment is roughly $17.5 billion. Our total investment is just under $23 billion under the MOU. So when you look at this in summary, it's an enormous undertaking. Any one of these developments, I think, from any practical point of view, should require a separation, individual assessment, financially, economically, environmentally. They're all really standalone projects that should be looked at in that sense. But here we have a collective situation where all of this is being bundled together in a hasty agreement and is moving forward from what we see at a very, very fast pace. So that's a summary of the MOU in a nutshell. Thank you for your attention. If there are any questions, we can take some.
Thank you very much, Gabe.